Hello and welcome to Livewise Fund in Focus. I'm Ali Selby and today we're joined by T. Rowe Price's Peter Bates all the way from the US for a deep dive into the concentrated global equity fund. Thank you so much for joining us today, Peter.
Thanks, Ali. It's great to be here.
Okay, there's obviously been quite large factor swings between growth and value over the last few years. You run a style balanced fund. What advice would you have for investors wanting to manage these extreme market fluctuations?
Invest in a way that balances your factor exposure so that you can win regardless of whether growth or value is driving the market. Because I think the last 3 years have shown, depending on which factor is working, that macro variable often overwhelms your returns. And so I think you need to have balance.
How do you actually do that though?
Yeah, I do it by creating a portfolio of 35 stocks that are best ideas across the platform, but the 35 stocks fit a role. So I have a combination of growth and value in that pool so that regardless of whether growth or value is working, I think I'm picking the best of the pool. And when you mix it up, you get steady, consistent alpha. I call it a portfolio of no excuses. It's my job to manage that as a portfolio, and I can do it with 35 stocks.
Okay, a few follow-up questions there. How do you filter the universe to those 30 to 45 companies? And then also, that's quite a high conviction approach. Why is that key when it comes to global equity markets?
So first, T. Rowe has a fabulous platform. I'm a new emerging product that is effectively an incubated business within a battleship of an organization. We have 150 plus research analysts globally. I'm harvesting the best ideas from that platform. How do I do that? The first step is qualitative. I'm looking for roughly 4 things qualitatively. I want good businesses that are well managed. I want a sustainable competitive moat. I'm looking for an inflection catalyst, something positive that means what's happening today is going to get better 18 months from now. That's how stocks work. And then the fourth thing is I want to be on the right side of disruption. I want to either own the disruptor or I need to make sure I avoid the company being disrupted. So step 1 is qualitative. Step 2 is valuing the business and thinking about risk return. I have a process called the return matrix that allows me to do this. It's too much to go into now, but I have high confidence in this process. I've been using it for 15 years. Step 3 is what role does the stock create in the portfolio? So if I'm looking at a high growth company that I really like, well, I have to compare it to the other high growth things that I own, because if I just immediately add it because I like it, well, then what if another high growth company comes and another high growth company comes? Then I just become a proxy for the growth factor and I'm not offering balance to my investors. And then when interest rates spike, I'm going to underperform. So I very much think about portfolio fit and keeping style balance so that I don't get tilted with my factor exposure.
And then why is that high conviction approach key when it comes to investing in global equities?
There's all these trends that are happening out there, and there's also some just exceptionally special companies, and I think roughly 35 stocks is the right balance between conviction stock picking to focus on the best, most unique, idiosyncratic ideas that can significantly outperform the market, but still offering diversification benefits so that some of these factor risks can be balanced.
How important is top-down macro analysis to your process, if at all?
I definitely have views on the top-down, and where I use the top-down is to understand assets where a recession is priced in. Because it's very obvious if one end market is really bad and a different end market is really good, I'm often looking to own the thing that's in the end market that is bad, because often you have mean reversion in cyclical markets. Do I make big top-down calls on the portfolio because I'm convinced interest rates are going from 4.5 to 6, and because of that I need to own a certain type of company? I don't do that. Again, I want to balance the macro variables, which are really linked to interest rates, inflation, and then your growth sensitivity to the market, so that I can drive my returns through idiosyncratic stock performance, and that's how I deliver consistently with no excuses.
Okay, in your view, what's the secret sauce to success in global investing? And is there any data that backs that up?
Yeah, so the secret sauce, I think I've got a pretty good start at it, where I've been using this process. I've been at the firm 20 years. I've been managing money publicly for 9+. I know the strategy I'm on now is only a couple years, but I did run a sector fund for 6.5 years before taking this role. And in that time, with that public track record of 9+ years, I haven't underperformed the market a single year. Right. And I've generated consistent annualized alpha at about 3%. And again, it's the process of focus on qualitatively good businesses that have positive change catalysts, value the business and buy them when it's right, and then make sure I don't get tilted on the macro, either factors or cyclical risk.
With all that in mind, where are you seeing the most opportunity today? Are there any sectors that you want to call out?
I think the playbook is balance your factor risk, balance your cyclical risk, invest behind durable growth themes, find idiosyncratic stocks and companies that are going through positive change cycles, and then pay attention to valuation and risk return. It's kind of a 5-step process. Areas that I think are really exciting right now are some of these themes that we're aware of, and we're trying to find the best ideas in those areas. So AI has massive change and investment happening. Stocks like NVIDIA, Microsoft, Amazon, Meta are really poised to capitalize on those opportunities. Biopharma processing and biologic development is a massive theme. Stocks like Eli Lilly and Danaher. Danaher sells like the picks and shovels to Lilly, who is making the products. And obviously these GLP-1s are massive game changers. And then another theme that I think is durable is reshoring, because globalization, sadly, is not going very well. People are not getting along. But there's massive reinvestment happening in U.S. infrastructure, and so a stock like Steel Dynamics is really well positioned to capitalize on that.
Okay, you're also overweight Japan right now. The Nikkei has already lifted 15% year to date. Do you see that strength continuing? And if so, can you point to an opportunity you've identified in
Sure.
that region?
I'm overweight Japan because of stocks, not because of a broad call on the market. And actually, when you look at the Nikkei returns of +17, but you factor in the yen depreciation and translate those returns back to dollars, the Nikkei market has not been the best market in the world. The United States market has been. But I am overweight Japan because I found a few idiosyncratic ideas that I think are particularly attractive, and one I'll mention is Olympus. Olympus makes endoscopes. I'm a middle-aged man. My birthday is in like a month and a half, and I am responsible, and I scheduled a colonoscopy a week before my birthday. And the odds are that will be an Olympus endoscope. And the company has had some problems because of FDA recalls around product quality, but you've had a completely new management team. That's the catalyst for change that I referenced earlier. Yet, even though they've had some of these product recalls, they are not losing market share. In fact, they are launching a new product that is selling very well and causing sales growth to accelerate. So I think it's a really unique idea that can do very well in the market. And the last piece is its sales and its growth trajectory is really not contingent on the direction of the economy. So it is very much an idiosyncratic idea.
You're also overweight financials and healthcare right now. Why is that?
Financials is linked to views on interest rates, that interest rates could be higher for longer. So I own a lot of insurance because insurance companies benefit from inflation and higher rates. If you think of inflation, I'm sure you own a car or a home. I guarantee you your premiums have gone up from what they were 3 years ago. So I own a lot of those insurance companies that are selling those premiums. In addition, insurance companies invest the money, it's called float, that you give them on your premium before they pay out a claim. Well, with interest rates higher, they can make more money investing that float. So I am overweight insurance. I'm overweight healthcare because I think healthcare, I mentioned Olympus, I like the idiosyncratic nature of healthcare where your growth is not contingent on the economy because people care for themselves even in a recession. And we do have some of these healthcare products that are game changers. I mentioned GLP-1s, and so Danaher, Eli Lilly, Olympus is a unique story.
Okay, you've talked about a lot of the stocks that you're liking right now and a lot of the themes. When I look at the other side of that, something that you're not liking so much, can you point to a position that you've recently sold out of and let us know what happened there and what you learnt from that experience?
Sure. I use the term no excuses. No excuses for underperformance because I'm going to balance the factor risk and I'm going to balance the macro risk so that regardless of what environment we're in with interest rates or recession, I believe I can outperform the market. No excuses doesn't mean no mistakes, and I definitely make stock mistakes. I just need to be right more than I'm wrong. A recent example I sold was because I was wrong qualitatively. It was a fertilizer company called CF Industries that I owned because of the dysfunction created by the war and the difference between TTF gas and US gas. And basically the breakdown in the thesis where our qualitative work was wrong is Europe started to reintroduce coal-fired power generation into the market, which depressed their demand for gas, which was really, it just changed the thesis. And so recognizing I made that qualitative miscalculation, I exited the position. What I do think highlights the process, though, is I owned the stock for a year and a half. There was a definite opportunity cost to owning the stock, but because we bought the stock well when risk return was good, we didn't economically lose money in the stock. Our only cost in owning the stock was we could have owned something else that did better.
Just one more question. What role does this fund play in a portfolio?
I think this can be the pillar of a portfolio because, again, I'm offering steady, consistent alpha with no excuses, regardless of the market environment and regardless of whether growth or value is working, interest rates are up or down, or regardless of where we are in the economic cycle. I then think asset allocators use this pillar to say, you know, I believe interest rates are going to fall, I want more growth. Well, then they can add specific growth to what this offers. Likewise, if they think, I think interest rates are going up, I want more value, I want more commodities, inflation, they can add things that give them that specific exposure.
Okay, well, thank you so much for your time, Peter. It was awesome to have you here in Sydney, all the way from the US, and tell us a little bit more about the Concentrated Global Equity Fund. Thank you for your time.
Great, thank you. Happy to be here.
If you enjoyed that too, don't forget to subscribe to Livewire's YouTube channel. We're adding so much great content just like this every single week.